I want to just talk for a second about why this is so important. If you've got a business that you're in the process of growing, or maybe you're trying to survive through some tough times, or maybe you're just wanting to get started, or if you're a real estate investor and you're trying to figure out, hey, how can I take advantage of some of these great short sales that are going on in my community? I mean, I just saw one the other day that was $58,000 for a 3-bedroom, 2-bath house, and in an area that's easily close to $200,000. Now, I'm certain it's all stripped out. You're going to have to do some work. But the problem is that typically you've got to show up on these with these short sales with money fast to get them to close. So that's part of it. How do you find the money to doing that? Well, it's harder than ever than I can remember to get money, and yet there's so much opportunity. And that's why I'm so happy to have an expert today to talk about some of those creative solutions to raising capital. And with that, Dan, I'm just going to turn it over to you and let you go.
All right, thanks, Diane, and I really do appreciate you having us here, and it's a pleasure to be working with you and your team. And so first of all, we have our pictures. You can see myself and my brother. We're business partners. We'll get into that in just a second. And I want to stress here the tagline of how to get fast access to capital without the stress, frustration, and delays of dealing with banks. And I want to say that in some cases we do work with the banks, but we work for entrepreneurs. And that's really important because whether it's banks or it's private investors that are putting money into doing some of these things, our priority and our focus is on helping the small business owner, the real estate investor, and so forth. So with that, we will forward here. Who are we? My name is Dan Kalis, like Diane said. I've been a B2B professional in different capacities, mostly in the financial industry since 2000. Been in the mortgage and real estate industry in a couple different capacities, account executive, doing some with some lenders, working with some down payment assistance, credit repair. Been doing business lending in different capacities on and off since 2009, which was a pretty bad year to be involved with that and anything for that matter. And been through a lot of different real estate investment seminars, training, done some small deals. My brother Joe is actually more of the ops and IT and systems person, has a lot of experience with customer service, team building, leadership, that sort of thing. And the Funded Entrepreneur, which is under kind of our umbrella company of Calbro Funding, is a full-service commercial lending brokerage, and we work with about 10 different lenders in a variety of different options. And I think one thing that's important to know is what we believe and where we're coming from and the value that we want to provide to any of you, whether you work with us or work with Diane or not. We believe that a well-capitalized entrepreneur is properly positioned to invest in things that matter most. You can see I'm reading on the screen here, but doing marketing and advertising that really matters, and that could be no matter what type of business you have. Disruptive innovation in tech, putting efficient systems together, and investing in people from a leadership standpoint. We also believe that every smart real estate investor, we would imagine many of you are real estate investors and some are traditional business owners, can and should always take advantage of all the funding and capital you can get your hands on. The different seminars and things I've been through and talking to multimillionaire real estate investors, they always say, if you can get business lines of credit, you need to do that. And so that's why we're so excited about working with that community. If you're a savvy direct response marketing expert, in other words, online, offline, you know how to get returns, you know how to do testing, you know how to use marketing as the ultimate source of leverage, this could be something for you in working with your projects. And we believe that access to capital is more important than the cost of capital. If we were talking to consumers, it might be the other way around because the cost is really important, where access to capital is really, really tough right now. We'll get into that. We also believe in the fact that businesses and commercial services are much less regulated than consumers because it is assumed that an entrepreneur is more financially literate and willing to take on calculated risks. And that's part of why it's so important for us to be transparent. For us, we value our referral partnerships. We value working with people like Diane and her partner Megan, that we want to show you and we want to be transparent and show you that what we're doing is credible and it works, and we want to prove it to you. And we also believe that the economy in this country is based on debt, like it or not. Federal Reserve notes that whole system is a debt system. And so when lending and borrowing doesn't happen, there's a liquidity crisis, and that's what slows down the economy to a certain degree. And I'm not an economic expert, but that much I know. Some of you may have seen this before. This is a really interesting list of 8 top reasons small businesses fail according to the Small Business Administration on their website. What's most interesting about this list is that I would say 6, probably even 7 of these things have an implication with capitalization and funding. Lack of experience is obvious. Insufficient capital, they just run out of money. Poor location. Well, if you have a bad location and you can't move, what do you need? You need funding. You need either a commercial mortgage, you need some kind of line of credit, you need money to move into a better location. Poor inventory management. We're going to talk about some ways of using lines of credit and some other things to manage your inventory, to take advantage of, whether you're a real estate investor or a TBO, a traditional business owner, of getting discounts for paying sooner and buying more volume. I know for a fact, I just talked to a roofing company wholesaler. They're super excited about working with us as well because they said none of our commercial roofing clients take advantage of the fact that we offer a 10% discount for volume and a 10% discount for a net 10 payment, and he's so excited about taking this to them. Overinvestment in fixed assets. Was just talking with Diane. Obviously, she's a CPA and an expert on this more than anybody here probably. But non-income producing assets, kind of wasting a lot of money that you have in the early stages of really nice offices and things that don't produce income. Poor credit arrangement, personal use of business funds. You want to keep things separate. That's why it's so beneficial to get away from using sometimes your own cash, sometimes your own personal credit cards. And then unexpected growth. If you have a lot of unexpected growth and you don't have the capacity to scale with that growth and hire people and bring on equipment and do things that you need, the growth is going to crush you. And so all these things have some kind of implication, with the exception of lack of experience. But even that, if you experience something and you need to go get a trade industry training as a real estate investor or a restaurant owner, it costs lots of money. I mean, tens of thousands of dollars in some cases for mentorship, for training. So I guess we could really say that being funded properly would help with all of these things. Who's this for? We already talked about this. Traditional business owners, so if you're a merchant, a business owner, a startup in a kind of a typical sense of Silicon Valley, you're trying to get that big idea with a huge exit with a venture capitalist later. Real estate investors, rehabber, or income property. We'll talk about that in a bit. And B2B providers. If you are a professional that deals with small business owners or real estate investors, you want to know about this and you want to make this as a resource, especially if you are selling something that requires money. Again, going back to the roofers. These guys are selling commercial roofing, and number one objection, or even if you're selling search engine optimization, I don't have the money, I don't have the budget for this. So it's a way to be able to get those things. Our objectives here are to provide you with some insights into the commercial lending space in general so you can make the most informed decisions when you're seeking funding, whether you work with us or somebody else. I want to briefly explain the 5 C's of lending. Some of them in there may be a little bit interesting to you. I don't know if some of them were kind of shocking to me. And there's an emphasis on personal credit rating, which we'll get into. We're going to highlight some features, benefits, and terms of unsecured business lines of credit because it's really the most versatile program that we're aware of and that we actually do help people with. And there's other types of funding available, different types of programs we'll touch briefly. And then we're going to have a Q&A session afterwards. I'm actually talking pretty fast, as you may say, also for one reason because I'm really excited. Another is that I'm actually from Chicago, and another one is because I want to make sure that we have time at the end for questions and answers. So this is being recorded, so you can go back and listen. But common funding methods, okay? So no matter what you do for business, there's going to be a limited number of ways you can go get funding. The first and foremost one that most people will want to do or try to do, and there's pros and cons. Bootstrapping. Use your own cash or your own revenues to fund your business without taking on any debt, without taking on any investors. The benefit of this is that it's the cheapest way to do it unless you lose it all. The negative side is that it diminishes your liquidity. And even we talk to people often that their net worth is in the millions, tens of millions in some cases, but they're not liquid. They have it tied up in assets and real estate and stocks and bonds, or they might even have $100,000 or $500,000 in cash, but they don't want to diminish that. They want to leverage other people's money. This one's kind of funny, I guess. This is a term I think made up by angel investors and venture capitalists, FFF, friends, family, and fools, which they would probably say are one and the same. Those are kind of obvious. I mean, a lot of people get money from their relatives, their parents, and it's a tough thing because it's inexpensive money. You want to be able to do that, but obviously the downside is that you can really ruin relationships that way. Traditional banks, which is kind of the target of our tagline, traditional banks, the Chases, the Citibanks, the local community banks, the credit unions, they don't really want to do microloans, things that are under $1 million. They will do some of them, but their goal is to get the checking accounts, to get investments, to get the whole package. And they don't really make it very easy, and their models are not set up in this day and age to really do more than what they've done over the years. Full documentation, and we're talking they're going to ask you for, tax returns, balance sheets, profit and loss, personal guarantors, credit reports, blood samples, all these things, right? I hope they don't actually ask for blood samples. I'm kind of joking. Insurance companies do ask for blood samples. So there's a lot of challenges with that. The process can be really long, and I would also include SBA loans because those go through traditional banks, and we've heard people that go 3-4 months in some cases and don't get anything out of it. So I don't really think I need to explain. A lot of you guys have been through the rigorous process of talking to bankers, and in a lot of cases, these bankers are posturing the business owners and really kind of making them feel like they're make them beg for money, and that's just not a position we want to see anybody in, and we don't want to be in. If you take on business partners, whether in the beginning or later, there's benefits. I mean, there's expertise that comes in. If you watch the show Shark Tank, for example, I mean, I would love to have Mark Cuban or Damon John or any of these guys. I would love to have their expertise and their connections, but a lot of times dealing with partners or even investors, they don't have time for that. So a lot of times you're sacrificing 50% of your profits and or your equity indefinitely, which is the most expensive option, frankly. And, sometimes you can bump heads and it doesn't work that well. Investors, same thing. You could be giving up a lot of equity and just be put through the ringer. But incidentally, we hear of people that are starting a local restaurant or something that's a local business, and they expect that maybe they're going to get money from an angel investor because they don't really have assets, they don't really have a lot of things. They think their idea is just good enough. And the fact is that 99% of these investors won't fund a business unless they can scale it to a 9 or 10 figure exit. I mean, hundreds of millions or billions of dollars. And they won't touch real estate investments with the exception of maybe to a lender that works with real estate investing. So now we have different options that are out there outside of the traditional sources, which we would just call non-conventional or alternative programs. I put business lines of credit as number one, and again, I'm going to go into the features and benefits of that in a bit. But this one is going to be the least amount of documentation, like basically none, and it's very driven on personal credit. Let's hold off on that for a couple minutes. But other things, and we do all of these things, and my intention is just to make you aware of what's out there. Revenue-based loans will go down all the way to a 500 credit score. They're going to be unsecured as well, and it's going to be largely based on what the cash flow can support. And the terms of these loans is going to be anywhere from 3 months to 4-year payback. They're very flexible. They're very innovative, very technology-driven. They're going to look at hundreds of data points. One thing that's really interesting, and I'll get into this when we talk about the 5 Cs, about what they look at. Equipment leasing, again, we can and other companies in that space can go down all the way to a 500 credit score. They're going to look at the whole story. So if you needed to buy, a piece of construction equipment, if you're a builder in real estate, for example, you need some yellow iron. If you're a medical person, you need a diagnostic machine, laser, MRIs, software, stuff like that. If it's specific for equipment, they're leasing programs that are very beneficial tax-wise. And obviously, I'm not the tax professional here. Diane is, and she might be able to help. She could help you for sure if you're ever looking into that about writing off the depreciation and some of those things. Merchant cash advances are very popular, but kind of becoming very taboo. They're the most expensive form. They kind of give you an advance on your credit card receivables, mostly for merchants. This isn't going to apply to real estate investors. Factoring, purchase order financing is basically when you will say you have accounts receivable with a business that owes you $100,000 in a particular month. You can actually have a company that will advance you that amount minus a discount immediately, so you don't have to wait 30 days, 60 days, 90 days to get it from that person. Retirement account funding. There's a couple different ways of looking at this. I wasn't even really aware that this existed up until somewhat recently, and you may not either. But there are ways to actually use, if you have a qualified account, an IRA, a SEP, a simple IRA, or a 401k, where you could actually use the money that's been saved up in those accounts and roll them into an account. Basically, instead of purchasing like Apple or Microsoft stock in a trading account, you could invest it in your own company stock, which is a really great idea. Obviously, you may want to use a portion of it, maybe not all of it, but you're putting a lot of trust in yourself. But when you do that, there's no interest. You're not paying fees on as far as interest fees. There are fees with processing that. We could talk about that if you're ever interested. But it's a really neat thing. And that also would include if somebody has a pension and you're getting, say, $500 a month or $1,000 a month for the next 20, 30 years, you could actually sell a portion or all of your pension payments to get a discount. So if the rest of your pension payments represent $200,000, there's companies that we have access to as well, they may give you an offer and say, we'll give you $150,000 today. That's just an example. I don't know if the numbers always work out. And that's where note sales. You can also receive funding if you are, this is very relevant to real estate investors. If you sold a property to somebody, but they couldn't get conventional financing, they couldn't get a mortgage or any way, shape, or form, or if you sold a business, if you were, again, a restaurant owner and you sold a business, they may, for $100,000, they may put $10,000 or $20,000 cash down in your pocket, and then you hold a note. So in other words, they're going to make a payment plan with you over the course of 5 years or 10 years or however long that is. And if you're receiving that cash flow as a private note holder in real estate, which a lot of investors do, real estate agents know a lot of these people, or you sold a business and you're holding a note that you're getting monthly cash flow, you can actually sell that and get a lump sum of money at a discount, and that's a nice way to do it as well. Hard money is something that will be no stranger to those of you that are real estate investors, and I always say there's been thousands of real estate investors that have made millions of dollars using hard money. I don't downplay or talk negative about hard money. I say that the lines of credit we do is a great alternative to that, but hard money is going to be every single deal you do is going to require a security position with a lien, appraisal, full documentation, probably 2 to 10 points up front, and then anywhere from 12 to 18% APR while you're holding it. So maybe you're not, the buy low, sell high. That might be an example of buy high, sell higher. As long as your ROI is higher. It's a great way to do things, but I think we're going to talk about some alternatives to working around hard money. And then we have all the non-conforming commercial mortgages. Anything that you're doing that is a secured position, that's a home pass loan, where you're doing a rehab deal perhaps, but they're going to only give you 60% LTV. We can get into more details if you guys have specific questions, but we have access to some of these, but really there's so many limitations with these programs that it doesn't really work out very well for the fix and flip investor. All right. The 5 C's of being fundable. And this is across all these different programs as a generalization. And the first one is going to be, and it's not really in any particular order, the first one we're going over is collateral. So if a lender lends you money and you aren't unable to pay it, obviously they want to have recourse and be able to take something, repossess something back. It's going to be largely dependent upon the loan to value. So appraisals are going to be involved. Sometimes collateral of a residential home can be used, a commercial property, equipment, different things like that. They're going to look at the value of that. When it comes to equipment leasing, some companies may say, well, you're buying furniture, that's not very good collateral. What are we going to do with that? But there are companies that will say, if the rest of your financial picture looks good, then we'll take weak collateral, in other words, or software would be another one. How are they going to repossess a software license? But they will fund it if everything else looks good. So the collateral is important. Character, and this is what I was saying before, this is really interesting. Character has to do with, they're going to do some subjective research on your relationships through references in a lot of cases. I mean, and we're in an online world here in 2014 where there's so much transparency. I mean, if you do something wrong, you're probably going to get somebody putting something on Yelp.com, or if you're in the real estate business, Trulia or Zillow, and these companies, these lenders, I mean, I'm talking about traditional banks, non-conventional, all across the board. their underwriters are going to look, and I heard somebody say, we're going to look on this business's social media pages, and we're going to see what the customers are saying. We're going to see what people are talking about. We're going to see if there's a trend, if there's a lot of complaints, how they handle it. It's that subjective these days. And so we need to be really careful. And if you have no presence whatsoever on social media or the web, that's probably going to be looked at as a negative too, because then it looks like you're hiding something. Certifications, Better Business Bureau awards, et cetera. I'm going to quickly go through these. Capacity is important. That includes how good the personal credit is. In some loan programs, the corporate credit, which we'll talk about, ability to pay. So they're looking at how much cash are you bringing in, what's your debt to income ratio, debt service, how liquid are you, how much cash do you have in your bank account, capacity to pay. Capital is going to be how strong is your balance sheet, assets, liabilities, cash on hand. Do you have skin in the game? Are you personally invested? Over time, if you can show in all these capacities that you have depth in all these areas, then your options are going to open really greatly. And then conditions is something that in a lot of cases can be totally out of our control. Conditions of the market, the economy, local, national, just depends. Location, you always hear. Is it a distressed area? Is it affluent? There's a difference between maybe investing in, not to pick on Detroit, but that's kind of an area that's been underdeveloped and is coming back up, versus La Jolla, California. Okay? So conditions are going to be really important. The importance of personal credit is something we run into quite a bit, and there's some terms and jargon. I'm just going to go over a couple of them. DU, debt utilization. Simply put, this means if you have a personal credit card with a limit of $10,000 and you have a balance of $10,000, you have 100% debt utilization. You're maxed out. Or it could be if you were over the max, that would be even worse. Definitely don't want that to happen on the personal side. Debt to income ratio, DTI. This is something that mortgage companies will look at, a lot of traditional lenders will look at. On the alternative side, not as much, but this is where they're going to take the monthly expenses that report to your personal credit report. So if they say you're paying $500 a month for this mortgage and $200 a month for your car, they're going to add that up, and then they're going to do a ratio of what your income is, your gross income, and they want a certain percentage. And it depends totally. It's different in every type of lending program. 15% debt utilization rule. This is interesting. You would think that if you had open personal credit cards and a zero balance, that would give you the highest credit score possible. But in reality, if you have a 15 to 18% utilization, you would have a higher credit score because the banks look at it and say, this person is using their credit. They're not just sitting there with an empty account. They're using it, and they're using it responsibly. For the sake of, a lot of some of the programs, the lines of credit that we do, 40% is going to be the max. So on a $10,000 limit, $4,000 is going to be kind of the max on that. And by the way, personal credit, some of you may know this, but in general, the high would be 850 as a FICO score. And there's different models. And again, if you go for an auto loan or a home mortgage or a business loan, they're kind of on different scales. But in general, 850 is about the highest you can get. They're going to look at more on personal credit if there's no collateral or financial docs involved. A couple things here about credit repair and credit enhancement that's really important, whether you're looking for lending or not. The reason why you can get something removed from a credit report, you may have heard people say you can do this. If you have a bankruptcy or a foreclosure, or if you're applying for lending and we were to review your credit or somebody else and say, there's some issues here, there's a late payment from a couple years ago. The thing that's going on is that almost every creditor, I don't care if it's a major bank, a local court, a jurisdiction that put a foreclosure on, there are consumer protection laws, the Fair Credit Reporting Act, there's different things like that, where these creditors are in total violation of, whether they know it or not. And when they are called on those things, then you can get things removed. So there's things that can be removed because of the way the creditors treat them, not necessarily because they don't exist. And with that said, if you do work with a credit repair company, and we have access to some reputable specialists that can help with that if you ever wanted that, because there are a lot of people out there, just like any other industry, that will do things like, believe it or not, there are some people that will call it credit repair, and they will basically file a police report on your behalf saying that there was identity theft for every one of these trade lines on there. And so when that happens, the bureaus have to immediately remove it for a set period of time, but most of the time they're going to realize that it's fraud, and you don't want to go down that route, and you want to make sure you know that whether or not this person is doing that, because a lot of them do. Also, there are services out there that will tell you, we can get you put on as an authorized user. So like, let's say you got a personal credit card and your son or daughter, you wanted them to have a card, you trusted them enough, they would have a separate card and they would be an authorized user, and they would benefit in some ways from that credit that's on there. And sometimes the banks look at those and they write it off. They say that's not valid because, you know, the guy's 30 years old, but he's got a credit card account that was opened in, 40 years ago. Well, it's impossible. But sometimes what they'll do is they'll actually put you on as an authorized user of people you don't even know, and that's just opening it up for problems. And also, just having really great personal credit affects other things like your insurance rates across the board. And if you happen to work a traditional job and you're doing some business on the side, there are a lot of jobs that will look at a personal credit and they'll turn you down because of that. Real quick, I want to whip through corporate credit basics. So there's been a lot of hype over the years about this idea that you can build up your corporate credit to the point of where you can get these big lines of credit without a personal guarantee. In other words, they're not going to look at your Social Security number. Your personal credit doesn't matter. It's only everything else. And whereas you may have been able to do that 5, 6, 8 years ago, it really doesn't exist now. And it does, and it really works. Somebody let me know because we'll offer that, but it doesn't really work. The factors in corporate credit ratings are the bureaus, Dun & Bradstreet, Experian Business, Paydex. Those are a few of the main ones. There's a couple more. Equifax has one. Vendor accounts. If you have accounts maybe as an investor, real estate investor with Home Depot, Office Depot for supplies, Quill, stuff like that, the more of those that you have with a solid payment history, the more it's going to help build your corporate credit. Age of corporation. In the context of anybody that would be looking at corporate credit, they're obviously going to put more stock in a company that's 2 years old than brand new, or 10 years old, or 30. And there's ways around that if you're a brand new corporation where you have the benefit of having some aging, which is shelf corporations. And it's a totally legitimate way to basically, what you're doing is you're buying a company that exists that just doesn't have any assets or revenues. Okay, you're able to benefit from a 10-year track record or history that ideally when you buy it, it's free from any kind of liens or judgments or anything. And that's actually something that Diane and her team do provide, and I recommend that if you wanted to go down that route, you talk to her about that because it's a way to get some additional aging, and you can use that corporation. Usually they're in general names, but it doesn't commit you to a certain industry. Type of corporation. Do you want to do a C Corp, LLC, an S Corp, an LLP? My brother and I recently kind of been going through that, with figuring out how we wanted to get set up. We ended up wanting to go with an LLC, but again, that's something that Diane and her team and her partner Megan focus on. But that will, depending on what type of things you want to do, it's important what type of corp you have, the way that people are going to, the other companies are going to look at working with you. The benefits, again, are going to be better terms with vendors. They're going to let you take longer to pay. They're going to give you better in-house rates. And when you do traditional bank loans, if you do them, they're definitely going to look at corporate credit. All right, I'm going to try to speed through here a little bit now. Common uses for funds, traditional business owners or startups. There's a lot of different things that can be used, but the most typical uses when they survey businesses, marketing and advertising. I mean, you could spend thousands of dollars a month, and if you know what you're doing and you hire somebody, if you're doing radio or TV ads or billboards or high-end search engine optimization, things like that, websites that are done well, supplies and inventory. Again, you can take advantage of volume and early payment. Payroll and staffing, expansion, technology. If you want to acquire other businesses, expansion. And probably the most basic is just to cover your costs, maybe during cyclical times. It's just cash flow management. Real estate investors. Okay, so this is the example Diane was talking about, this property for $58,000. Perfect example. With our lines of credit, could be anywhere from up to $175,000. You can acquire properties. You can do the rehab with them. You can use marketing for reselling the property. It's a great supplement to having hard money or using your own cash. And if you're an income investor, you probably wouldn't want to actually use lines of credit in this capacity, the unsecured ones. They're they're a really great price for what they are, but it's not necessarily a buy and hold strategy. But as an income investor, you probably want to have lines of credit because you don't know if all of a sudden, you're going to have 3 refrigerators blow out in 3 of your properties in one day, and all of a sudden you have, $5,000 or $10,000 expense. I don't know how. I haven't bought a refrigerator ever, so I don't know. But things like that happen, and you want to be able to not have to deplete your own cash. Okay. The features of the business lines of credit, and the reason we talk about these is because they're so flexible and they're so ideal. But if this doesn't fit what you're looking for, don't be discouraged because there's other things that are available. But this is ideal for any business type, typically $10,000 to $175,000, 0% interest rate for the first 6 to 12 months, no documentation, so the financials, the appraisals, the tax returns. Wouldn't even need to sit down with any kind of banker. We do everything by phone and web, paperless at that. No collateral is required, no fees up front or out of pocket, approvals within 24 hours, and access to funds within 5 to 15 days, just depending on, it comes in increments. The way we do it is we work with, we'll get multiple lines from different lenders. So if we're helping somebody get $100,000, it's not going to be one line for $100,000 because in order to get that, it would have to be full doc, all these things that are very frustrating. And the strategy is that we're going to go to multiple banks and have the same effect and get a $20,000 line from here, a $30,000 line from here, help you liquidate and consolidate it all into one bank account, and it works out really well. The benefits of using that type of program, they only report to business credit profile. It doesn't report to personal. You can max out those accounts and leverage the entire amount without hurting your personal credit. If you did that with personal credit, you'd have a tremendously lowered credit score. It can be used for any business purpose without any reporting or oversight. A lot of times if you're doing hard money, if you're doing certain equipment leasing, you're pigeonholed. You have to use the money for those particular approved expenses. And if you don't, then there's huge probably, fees, penalties, all these things. You can keep open and pay the lines up and down as needed without any specific payback deadline. So it's very flexible. It's not a set term. You can use it when you need it, and you can pay it back when you don't need it. And again, no headaches with the consuming process. No down payment is required if you're doing like a conventional loan, a mortgage, certain things like that. There's no balloon payments and no prepayment penalties. So here's kind of the catch, if you want to call it that. This is qualification for this kind of thing. 720 plus personal credit score. Could be you, could be a credit partner. A lot of our clients use credit partners, whether it's a business partner, a spouse, what have you. It does require a personal guarantee. A use of a corporate entity, the success of a sole proprietorship is just pretty low. 2 years plus would be ideal, but if the credit is strong enough, we can work with a brand new corporation, and that's how we can work with startups. No derogatory information, so no late payments, no collections, charge-offs, things like that can be on there. If there are some things on there, there's ways to get them off, but in the immediate term wouldn't qualify. It's kind of a zero tolerance. Minimal amount of credit inquiries, maybe less than 5 or 6 in the last 6 months, less than 40% debt utilization on personal credit cards. We talked about that. The age and available credit on personal credit cards is key. So the more personal accounts that you have, credit cards, with the higher limit, so 5, 10,000 plus limits with low balances and that are at least 2 years old, the better. That would be considered a thick, quote-unquote, credit profile. And we do charge a one-time funding fee of 10% after the completion of funding, which is pretty industry standard, and it's actually kind of a wash since you're getting 0% interest rate in the first, usually 12 to 13 months, sometimes 6. So it's kind of a wash, and it evens out. And that fee can be paid out of the corporate credit cards that are attached to the lines of credit, after the funding period. So nothing comes out, and you can actually take about a year to pay it off because there's no principal, and so you're on a $100,000 line of credit. You're basically paying $100 a month to keep that open. We can provide, if any of you are interested in us helping you, we can provide some specific proof of funding if you wanted to see it. But just one example that comes to mind. There's a gentleman who owns a painting supply company in Ohio, I believe, or Pennsylvania, and he had been going through this process with, we'll just say it's a major national bank, and he said, I'm going to be able to get this. I got great credit. I don't need what you guys have. And I said, no problem. Just let me know if anything changes. And lo and behold, 3 months later, he said, they've been dragging us through the mud. We're in there with our banker. We've been working with them for 20 years, and they just they're just not coming through. They're just really frustrating us. And I said, okay, well, let's try to do this on our end. And with that same bank, through our channels, kind of through the back end with the commercial side, we're able to get him a $30,000 line of credit in addition to a number of other lines added up to about $100,000, $150,000. So even some cases going to those banks, they won't give you what you want. And what do we do for you? Can I do this myself? When we kind of put this together, you have to kind of sort through thousands of different credit issuers that are out there to find. We have, in particular, 5 to 10 that offer the 0% APR, that will approve real estate-related businesses, that have the higher limits, that are no documentation. We apply for credit on behalf of our clients to multiple lenders, taking the time that you may or may not have or want to take, and avoid declines. If you go and you get declined by one, a lot of these banks, they share underwriting, outsourcing with other companies. For an example, Chase and Citibank may use the same underwriting. So if you put too much on the application, you don't put enough, you don't do it how exactly they want it, then they may decline you, and then everybody else may decline you just because they did. Monkey see, monkey do, the domino effect. And as Diane can attest, just like working maybe with certain agencies that are financially related, there's certain things that they need to know, and there's certain things that they don't need to know. And you can sometimes go overboard and tell people too much. You could do that in personal relationships. You could do that in financial relationships. And the question we always ask is, would you fix your own roof? Would you design your own website? Would you represent yourself in court? You could. You may be able to. And if you're that type of person, then feel free to do that. And we can kind of give you some pointers. But most of the time, it's not really an option. Entrepreneurs leverage their time and energy by outsourcing. So, as Diane stated, it's really important to acquire funding before you need it. It's just kind of how things work, that when you're not looking for it and you don't think you need it, is the best time to get it. When you really need it, sometimes it doesn't come through. Lines of credit are great for that because, like I said, on $100,000, it would only cost $100 a month to service the balance of just the funding fee alone, and you could have access and pull the trigger with cash on a deal immediately. And that's all I had right now. And Diane's going to facilitate any questions. Really appreciate all of your time.
Dan, while you were talking, I didn't want to interrupt you, but I was making notes of things, just comments. And what you said, we haven't even discussed this, but when you were talking about the equipment leasing, just a heads up for anybody on this call, effective January 1st, 2014, Section 179, and the Section 179 is what let us take that big immediate write-off whenever you bought equipment. Last year, 2013, the amount you could write off was up to $500,000. For 2014, it's been decimated. It's $25,000 only. Wow. So right now, if you go with financing, which by the time you work it out, a lot of times financing, and as far as you're doing the equipment leasing versus financing, the numbers end up being very similar. But if you do equipment leasing, it's 100% deductible. Whereas if you do the financing, you're going to have to capitalize it and depreciate it over, maybe 15 years. So it's a much better deal right now to do equipment leasing.
Right, and then there's also no, thanks for bringing that up, Diane. That's a great point, and that's crazy. The other thing is that there's a concept called obsolescence, which again I think is more of an accounting term. You probably know. I don't even know how to spell it, but it basically is that when you're buying equipment, the idea is that through innovation and technology, you don't necessarily want to be stuck with a piece of old equipment that you could be upgrading. And when you lease equipment, there's some really good incentives for upgrading without having to come up with a lot of extra money out of pocket. So, whether that's especially medical equipment, software, things like that, that's another benefit. But I don't want to get too far off on that.
I just think that if for anybody listening, that's just a real tax tip with an asterisk on it. If you're looking at equipment, look into getting. Don't buy it, lease it. I mean, for tax purposes, huge benefit right now. The other one.
We found a lender that will actually work with somebody down to a 500 credit score. They'll look at the whole story. Wow. They'll get really creative. And then if somebody has really great personal credit and all that, then the terms are going to be a lot better. So, there's accommodations for everybody across the board on that. So we'd love to be able to help.
And I've got one more asterisk I want to put on this, and I think I shared this story with you personally, of somebody who went in and just got their own credit cards thinking, hey, I'm going to get more credit, and one way to get around the only utilizing 40% is just get more available credit. And at the same time, what she did is she went out and got store credit. So you know when you're going to Macy's or whatever and you buy something, you say, do you have a Macy's card? No. Well, if you get one today, you get $15 off or whatever, and people sign up for it. And so she did that thinking that's really going to help my credit score. But actually what happened is she ended up getting 6 inquiries in less than 6 months. Now, she was in the process of going to buy a house. And the house was, I think it was about $250,000 if I remember correctly. But those 6 inquiries in 6 months dropped her credit score by over 70 points. And that was enough to kick her down into a lower range. And even though she'd been pre-qualified for a mortgage loan, they backed out of that amount because her credit score dropped so much. As a result, she had to get a much higher interest rate, and over time it's going to cost her another $150,000 in interest.
Wow.
$150,000 in interest. And she did this thinking it would help. So that's the thing, is you got to be careful when you're trying to do it by yourself.
Well, let me say something else too about inquiries. Is that that would be kind of an extreme case with 70 points, because typically each inquiry on every credit bureau would generally result in about 3 to 5% drop. So there may have been something else going on at the same time, but
Sure.
Nonetheless, I mean, yeah, 6 inquiries can drop you, 20, 30, maybe 40 points in general, or maybe when it's all consolidated, it could be 70. I mean, it's you never really know because they change their criteria. But yeah, exactly. If you ask for a balance limit increase, they're almost always going to do an inquiry. People don't realize that. But the nice thing is that, like anything else, there are ways to get inquiries removed from the credit bureau because they're reporting them incorrectly. So there are sometimes ways to do that very fast. Sometimes it takes a little bit longer. And when you do get an inquiry removed, it reflects real time on the credit bureau. You don't have to wait for a billing cycle. So yeah, that's one of the biggest hurdles sometimes for people, and you definitely don't want to do that before you go to apply for a mortgage.
Right. So it's the same thing as here. You're looking for getting a business line of credit, and if you're trying to do it yourself, and like you said, you get somebody turning it down, then it just becomes that domino effect. It's like everybody's turning you down, and now you got to wait a year for things to kind of clean up again. Okay, I got some questions. I'm going to actually take these out of order because I've got one question that I have a feeling you and I are going to talk about for a while. I'm going to leave that one down.
Okay.
Do that a little later. But the first one is, can a business line of credit be called by a lender, or is the time for repayment fixed?
Oh, good question. Okay, this is something that we haven't ever seen in, I would say, the last 5, 6 years, because that's typically more of a mortgage kind of thing. I saw that happen in some cases when I was in the mortgage industry. I would just say this: it's very, very unlikely, but and I think Capital One got in trouble for doing this to a lot of people. The banks are the banks. I mean, let me just say that I don't have any special love towards the banks at all, but I do like using what they have to offer to help entrepreneurs, like I said. But sometimes they have fine print. They have adhesion contracts where they will do things like they'll just close your account without telling you. They'll lower your limit without telling you. More on the consumer side. You really don't see that on the business credit side as much. Okay, so I want to say that. But sometimes they're never going to say you owe the full balance. I shouldn't say never. We haven't seen it. It's very unlikely, and I think that really comes down to more when it's a secured line of credit, because banks have departments called REO, real estate owned, on their books. Mm-hmm. They don't want to have real estate owned on their books. Banks are not real estate investors, so they're very cautious when it comes to secured loans, way more so than they do when it comes to unsecured, because a lot of times they can just write those off. So.
It's interesting. When I first started my business, which was like about 25 years ago, and I had a business line of credit that was more traditional, which, by the way, it's very hard to find those anymore. But I had one that was secured by my accounts receivable in my accounting practice. And part of the terms of that was I had to be out of the loan for 1 month out of every 12-month period, rolling 12. So there had to be 1 month that I owed them nothing. And that was kind of the way it was done 25 years ago. But you don't find that, I mean, because they don't make those kind of loans mainly. Basically what we're talking about here is much more similar to a revolving line of credit, like credit cards, and only they're for businesses. And so the rules are different, right?
Yeah, I mean, let's just define a line of credit. It's not, people ask different questions around that. Is this a traditional line of credit? I mean, a line of credit is a revolving account, period. I mean, if it's a HELOC, which is a home equity line of credit. That's a line of credit that's attached to your home. You get a credit card with it. You can't, if you took a cash advance against that, you'd pay exorbitant fees just like you would with a typical personal credit card. It just means it's revolving. Now, whether or not the bank or the lender actually is willing to deposit money into your account without any additional fees, you know, that's where it gets tricky. On a traditional line of credit, yeah, you might be able to go to your local bank and get it with again, full documentation package. You might have to wait a month or two, you know, collateral, personal guarantors, all these things. They may give you a $100,000 line, and when you want money, they may deposit right in your bank account. With what we do, it's a little bit of an extra step, but man, it's just so flexible because, I mean, you need to get it into your bank account. You may have to pay a 2 to 4% fee to kind of process that, but it's not a cash advance fee. So it's worth it to be able to do that, but that's really what it comes down to. A line of credit, revolving, no set payback term, whether you want to call it a credit card, a line of credit, these accounts, some of them have checks that come with it. You can do a regular check transaction, or you can turn it into cash.
And you didn't see me, but I was shaking my head when you were saying you can go to the bank and maybe in 30 days get a line for $100,000. I got to tell you, Dan, I haven't seen it in a long time. The only people I'm seeing get lines of credit like we used to get 25 years ago are people that are either have long relationships with community banks, so they're small banks, and it's long relationships that they've been working with them, or they're getting lines of credit that are just tiny compared to the amount of revenue they make. I mean, they can get that line for $100,000 if they net $1 million. You know,
right.
It's that kind of numbers, and that's a real instance, by the way. I just don't see. It used to be you could get those, but it's like I haven't seen them for a long time. So it's kind of like times have changed.
Yeah, and that's why I always say, you know, it's pretty amazing that we could help somebody, and it's not everybody can do it, and it's not for everybody. I'm not saying that, but it's like the fact that you could get up to $175,000 in business lines of credit on a signature is kind of unheard of. And again, most people don't have the credit to do that, but with some ingenuity, entrepreneurs are resourceful. I had a guy who was a new real estate investor, wanted to get into it, didn't have the credit. I said, why don't you go to like a real estate networking event and see if you can find somebody that would be a credit partner, almost kind of joking to him. And he called me back like a week later, and he was like, I found somebody, and she was good, and we got him, it wasn't like a huge line, but we got him like $60,000. And so people are resourceful. And, oh, by the way, one thing I didn't mention earlier is that after that 0% interest rate period, the lines are generally going to be between 10 and 13%. And I just want to put that in perspective that if somebody's coming at this looking at comparing business funding to residential mortgages, let's not do that, because a residential mortgage is totally different. You're living in the property, you put money into it, there's a secured position. That's the only thing you're ever going to get that's in those single digits for the most part. You're talking about business funding, you're almost always talking about double digits. But it's about what are you going to do with the money. It's about that access to capital. And so we believe that 10 to 13% APR is extremely low, especially for unsecured. And if somebody's kind of like got this dream that they're going to be able to go to their local bank and get a big business line of credit, $100,000 for 5%, I'll be here after you get done being frustrated, and I'll pat you in the back and all that. But it's going to create a big headache. And I hope someday that does become available, and we'll get involved with that. But that's not the reality.
I've never seen that, by the way. And like I said, I've been in business for 25 years with my own company.
Yeah.
And I've never, it's always been, I don't think I've ever paid less than double digits. I mean, I don't think it's ever been less than 10%.
And I think most people would consider you to be a pretty financially savvy person, Diane. And if you're willing to do that, then I think that's a lesson for everybody.
Well, you know, it comes down to, and I've got another question, and we're just rambling. I'll make it fast. But it comes down to what are you going to do with the money. And, like, if I can take a loan that I'm paying 10% on, and it's going to give me 20% return, then that, or 30% return, that makes sense. But, you know, if I'm going to take that money and it's going to end up returning me 10 or 12%, it's not worth it then.
Right,
so the whole point is ROI. When you're in business, it's all ROI. Okay, we have one more question, and we've got a lot of people. People have stayed on the line. We're talking about stuff that I think is important for people.
Appreciate that, everybody.
Yeah, thank you. Okay, this is so funny because you and I were talking about this just a couple of days ago. what if you want to use your retirement account for funding? Do you have to have a C Corp? So do you mind if I kind of start off with an introduction on that, and then I'll let you talk, because we both have worked with clients in this area.
Yeah, go ahead.
Basically, what the writer here is talking about is if you have a pension plan, let's say you've got a 401k from a job that you've left, and you've got this 401k you can roll over, and you've got an idea of, hey, I want to start a business, and I'd like to use that money that I've got in my pension. And unfortunately, a lot of times the first thing people think of is, okay, well, I'm going to cash it out and take the penalties and pay the tax, and oh my gosh, by the time you're done, you don't have nearly as much left because you've had to pay the tax and penalties. Well, a couple of things you can do. One is you can roll it over, and if you're planning on doing real estate, you can do a self-directed plan around that and invest in real estate. But there's a lot of rules around that. For example, if you're doing that with the real estate, you can't actively work in it. There's what's called prohibited transactions and disqualified persons, and you would be a disqualified person in a self-directed plan. So you can't go buy a property and you go fix the roof. You can't work in it. You can't draw a check as a property manager for managing those properties. The money has to all stay inside that self-directed plan. So that's one option. Another option is you can actually fund that money for a business that you want to start, and you can work in the business. You can draw a paycheck, and you can take loans again. You can do all that stuff. And the way that works is a program through the IRS called ROBS, R-O-B-S, Rollover Business Startup. And what the ROBS program is you would start a new company. It would have to be a C corporation, so in answer to this question, it could be an LLC electing C corporate status, but it has to be a C corporation for tax purposes. And you set up a pension plan, a 401k plan within that C corp. And then you roll over from your old 401k into that new 401k. And then that new 401k buys the stock in the C corporation. So you just rolled over $200,000 for your pension. You've now got $200,000 sitting in the 401k plan for the new company. You use that to buy the stock in the C corporation, and then basically you just transfer all that money to the corporate checking account. It's now yours to run with. You can draw out salaries. You could buy equipment. You can buy a franchise. I have a client who is buying franchises with this money. I have another client who is launching a startup company, and so is doing all of the manufacture and the patents and all of that with the money. So these are ways to start a business that you can do with a pension. And you have some experience, or you have some clients that have done this as well. Is that right, Dan?
Yeah, well, we're getting into this, and yeah, I just thought, because I actually used to be a stockbroker advisor, and so I never really even knew that this existed. And so, yeah, I don't think I could explain it better than you did, but except for just to say, like I said before, you can, if you, in your retirement account, you can invest in other companies that you have no control over, like Apple or Microsoft, so forth, or you can invest in the stock of a lot of people that the small business owner, that ABC restaurant, he doesn't think of himself as a stock issuing company, but he just owns all of the stock. And so, and with the specifically with the 401k, if you have to actually leave the plan, so you have to leave your employer. But like you said, the benefit is that you can immediately, within, I mean, probably a couple of weeks, start paying yourself a salary with that. So you could leave knowing that you have a salary right away. And I just think that's a really innovative and neat plan.
Yeah, it is. I love it because it gives people that money, that startup capital, to do something.
And it's not debt. They're not borrowing. They're not paying interest.
No.
They're just using their own stock.
Yeah. So, of course, you know, with anything else, you want to make sure you got the ROI for that. And so that means that you really, truly have a business that you're going to make money on, because if you're just using it to run out your pension, at some point there's no more pension.
Right.
You know, that was the last of the questions that we've got. Thank you. We did actually go almost an hour. I thought we'd be shorter, but these are such important topics to talk about. Thank you again for your time today, Dan. Appreciate it.
I appreciate having me. And let me just say, I don't want anybody to walk away from this being overwhelmed and thinking that, you know, this is so much information, there's so many things. The point of this conversation was to show that there are ways to do it that are not complicated, and the process is simple, and it's much faster than you may be used to. And in the capacity of Diane and everything that she does and what we do, we would love to have conversations, again, whether you do business with us or not, just to help guide you in the right direction. If you want a resource that's, you know, on something marketing related, we'd be happy to point you in the right direction. It doesn't matter. We want to help entrepreneurs, and that's where our heart is. So we hope that we can do that with you. And again, really appreciate everybody's time.
Thank you all for joining us. and I look forward to talking to you soon. And again, thank you for giving up part of your weekend, all of you here, and Dan, you as well.
My pleasure.
Bye.